Hey future millionaires, this is Phil from Next Chapter Financial Solutions and Services. In this video, we're going to go over index funds. We're going to go over what they are, the types that are available, a quick overview on how to buy them, and then we're going to do a deep dive on 4 index funds. And then take a look at what an account would look like if you invested in those 4 index funds over a 5-year period of time.
Getting started, we're going to talk about what is an index fund. So in this video, we're going to go through what an index fund is, types of index funds out there, and how to buy them. Now let's dive into what an index fund is. An index fund can either be an ETF, an exchange traded fund, or a mutual fund. Index funds are designed to closely mirror the performance of a financial market. And in the next slide or two, we're going to go over some of those markets or indexes that they follow, and that's what makes it an index. To achieve this, they're highly computerized, which leads to lower fees and expenses than an actively managed fund that is usually reflected in the expense ratio, and we're going to go over that. And this is great for a passive investment strategy. As I mentioned, there are several indexes out there. There are around 7 that we're going to cover today. You've got a broad market index fund. You got a market cap index fund. Market cap index funds will mirror a market cap, so that'll be like a small cap or a mid cap or a large cap. You'll have an equally weighted index fund where it'll tell you exactly how many funds it's trying to target, how many stocks it's trying to target and having in that fund. You'll have a fixed income and dividend fund. You have a sector-based fund. That's when your fund is targeting to only have a certain sector in there. That could be like technology, industrials, or energy, or even consumer goods. Then you have international funds, which will only have stocks that are international companies to the U.S. that is, and then you'll have another one is a socially responsible index fund. Now, how do you buy an index fund? Well, first step is determine the account where you're going to buy it. Since index funds are not typically in your 401ks, employer-sponsored programs, you can buy them in either an individual retirement account or even a brokerage account. From there, you open the account with the investment broker. We'll go through a quick list of investment brokers in the next section. Then you decide how frequently you're going to invest. We always advise when talking to people that the best way is to either go weekly, bi-weekly, or monthly, or as simple as every time you get paid. If you budget it that way, there's a small increment. Every time you get paid, you just do it that way. And then set it up finally to be automatic. Automatic transfers into the account and automatic purchases of said funds that you want to go for. That way you're enjoying dollar cost averaging, which basically means you're buying at highs and lows of the account, of the index fund pricing. Like any investment, there are pros and cons. Index funds have a few as well. You have lower risk through diversifications as a pro. You have lower expenses because it's so diversified, and following an index, you have lower expenses. You have strong long-term returns. It's ideal for passive and buy and hold investors, and since the buying and selling is less frequent, you have lower tax exposures typically, depending on the account you have it in. Some cons, the index funds do tend to be vulnerable to market swings. So if you're very sector-based in tech, and tech takes a hard hit for 2-3 months, your index funds will also see that reflective hard hit. But that's also an opportunity to buy on the low. There's some lack of flexibility depending on what indexes you go for, and there's no human element. If so, you're the type of everyday investor that says, I'd like to have a human element that has an active manager, then index funds may not be the best for you. And in the short term, people see that there's limited gains, but in the long term, it does have some strong gains. So to buy an index fund, you need to work with an investment broker. Here are a few that you should keep in mind. There are so many out there. I can't go over all of them. You've got Fidelity, Webull, M1 Finance, Charles Schwab, E-Trade, TD Bank, TIAA Craft, and finally Vanguard. And why do we mention Vanguard? They are the grandparents of index funds. Why? Because they created the first one in the 70s. That's right. They have the oldest index funds out there. And over time, they have shown some great returns with very low expense ratios. When you're trying to determine which broker, you need to do some research. Things to keep in mind: trading fees, ability to do fractional shares, Why is that important? Because the index fund could have a list price of, say, $550, and you only want to invest $500 per month. Well, with fractional shares, you'd be able to buy $500 of that $550, and then after that, you could buy even more shares. You want screeners to help you figure out which index fund you want to purchase or research and look at very quickly. You want some risk analysis to give you additional insights on the index funds. You want ability to have some overall ratings, and you want education and reporting and research ability. It's important to be an informed investor. And a lot of this information is really simple to read. You just need to take some time to read it over and gain some understanding. Next, we're going to go over some index funds. We're going to go deep into a review of them. First, we're going to start out with the Vanguard Total Stock Market ETF. So this is an ETF index fund which has holdings that go from large, small, and mid cap. It covers a lot of investments throughout the whole entire stock market. Followed by the Fidelity 500 index fund. This one looks like a mutual fund, invests at least 80% of its assets in stocks that are in the S&P 500 index. Followed up by the Invesco ETF that goes by the call letter of RSP. This one invests in equally weighted funds across the S&P 500, followed up by a sector consumer discretionary fund, XLY. This one tracks performance against consumer discretionary indexes. As we look at the first ETF, this Vanguard has holdings of Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, Meta, Berkshire Hathaway, United Healthcare Group, and Exxon. And that makes up about 27% of all of its holdings. But you get a great list of diversification, sector diversification as well. You've got technology, consumer discretions, industrials, healthcare, financials, consumer, staples, energy, real estate, utilities, telecommunications, and basic materials and other items as well. And to get all that, only expense ratio of about 0.03%, which tells us is about $3 for every $10,000. And you have some pretty good performance too. What do we have? A 1 year of roughly 19%, 3 year of about 13.76%, 5 year 11.3%, 10 year of 12.8%. All that in one fund. Now let's take a look at the Fidelity Mutual Fund here. We have holdings of Apple, Microsoft, Amazon, Nvidia, Alphabet, Class A and Class C. This again is the parent company of Google, Meta Platforms, which is the parent company of Facebook, Berkshire Hathaway, and Tesla. Which then when we look at the allocation breakdown, large amount in large growth, and the rest, another big portion in large value. In fact, between the two, this is a very large sector play of investment, and you have about 91% of your investment in these large areas, and then the rest in some foreign bonds. But to get all that, you do have some expenses, and it's pretty minimal. Because it's an index fund, that's the goal, to have very minimal expenses and show some performance. You have 0.02. So that means for every $10,000 is about $2 expenses. Next, what does that lead to in performance? You get your 1 year at 13%, your 3 year at 13.7%, our 5 year at 12.18%, and then finally our 10 year at 12.164%. All that in one fund. Now we're going to take a look at the Invesco ETF that goes by the call of RSP. So that's the ticker, RSP. For this one, you get a total of 503 holdings, 503 stocks. Big companies: Carnival, Norwegian Cruise Lines, Delta Airlines, Old Dominion, Southwest, Palo Alto Networks, Align Technology, Universal Healthcare, and finally American Airlines. And these are some of the top 10 holdings. Of course, again, with 503 holdings, we can't hold them all, run all through them in the video, but you get a lot of sectors. How many sectors? Basically all the big ones. Industrials, financials, healthcare, information technology, consumer discretionary, consumer staples, real estate, materials, utilities, energy, and communication services. All that is what you get with RSP. What's the expenses on it? 0.2. So that means for every $10,000 you have invested, you'd have pay roughly $20 of expenses. But let's take a look at what the returns would be. So 1 year would have been 13.51, 3 year would have been 15.58, 10-year would have been 10, 5-year would have been 10, and then 10-year would have been 11.18. Since its inception in this case, that gives us that, so we might as well tell you, is 10.8. So you have a lot of information here and a lot of good performance. And now we move on to the Spider consumer discretionary that goes by XLY. This is an ETF. Its top holdings include Amazon, Tesla, Home Depot, McDonald's, Nike, Lowe's, Starbucks, Booking Holdings, TJX Companies, and Ford Motors. And this one is heavily consumer focused, as it tells you that it should be. Top industries include broadline retail, automobiles, hotels, specialty retail, textiles, household durable goods, distributions, and automobile and leisure. As you can see, there's not a lot of technology here, as promised. That's exactly, they're living up to their goal. They're living up to their goal, and they're showing that promise to the investors. Now, what does the expenses look like? The expenses look like for this one, 0.10. So that means for every $10,000 you had invested, there would be about $10 of fees. What does the performance look like? You've got a 1 year of 24, 3 year of 10.8, a 5 year of 10.13, and a 10 year of 13. This is fantastic. If you look at it, this is a great depiction. If you could see it really trying to meet its index. It's really close, 24.7 versus 24.19. And even look at the 10 year, 13.03 versus the index, which is 13.18. That's the goal of an index fund. It tries to mirror and really be just about on par with its index in question. From here, we're going to take a look at what it would look like if you invested consistently in these 4 funds for 5 years. Okay, so here at Next Chapter, we never miss the opportunity to take it to the spreadsheets and do some analysis. So in this template here, we're going to go through all 4 funds. Again, we've got a Vanguard, we've got a Fidelity, we've got an Invesco, and then we have a Spider. And then we've plugged in all the returns that we've already reviewed, and we're going to take a look at what this would look like if we invested consistently over 5 years. So to make this more practical, we're going to say we've invested roughly $6,000 per year, invested consistently, and we're going to run it against those returns and see what it looks like. So it looks like this. In 5 years, if we invested $6,000 consistently, we would have roughly a balance of $41,400, and that would be broken up to $30,000 of invested dollars, and the remaining 11 and change would be growth. Now, if we did that for 10 years instead, what would this look like? I think you're going to be impressed. It would be roughly close to 50-50 split. So you would have roughly $60,000 that you invested, so $6,000 each year, builds up to $60,000, and the rest would be growth. And so it's impressive to see what returns would be like off of just 4 basic investments that are across different index funds. Hope you enjoyed this review. More details to come. Okay, so let's wrap this up. Thank you so much for watching the video on index funds. We hope you found it helpful. We especially hope that you enjoyed that wrap up of showing what it would be like if you invested all 4 consistently over 5 years and 10 years. If you want to learn more about personal finance, please check out some of our videos below. We've got a video on mutual funds and a video on ETFs. We've got some other ones on budgeting and the importance of emergency fund as well. If you like our template, please check out our Etsy page. That template it took a lot of hard work, but we really wanted to give people the tools to run their own analysis. And again, you just simple inputs, and then you plug in how much you're going to invest consistently. We've also got some money-saving templates as well. Please check those out. If you enjoyed the video, please like, subscribe, and share. Seriously, please like, subscribe, share with your friends and family. This is everyday information that can be really helpful to help you build wealth. More videos to come. Hope you enjoyed. Talk to you soon.